The broadcast is now starting. All attendees are in listen-only mode.
Hello, and thank you for joining us this morning for another Drewry webinar on the outlook for the container shipping market in the wake of Donald Trump's return as US President. I'm Simon Heaney, Senior Manager of Container Research at Drewry and the editor of our Container Forecaster report. I'm joined today by Philip Damas, the Managing Director of our Supply Chain Advisors Division. All told, the presentation will take about 20 minutes. There'll be 10 minutes for Q&A at the end, and you can ask questions anytime during the presentation using the panel, and we'll do our best to answer as many as we can. Any in-scope questions that we don't have time for will be answered in an email briefing that we will send out to registrants shortly after the presentation. That will also have a PDF copy of the slides and a link to the recording. Okay, let's get started. We can't say that we weren't warned. The new US administration is enthusiastically carrying through on its America First election campaign rhetoric, taking a chainsaw to the rule books on governance, foreign diplomacy, and international trade. The zone flooding onslaught from the White House means that there's going to be many unpredictable consequences for container shipping. It finds itself sort of in the crosshair of the geopolitical economic warfare, and it will be significantly distorted during this process, and not for the better. The outlook for container shipping is even more uncertain now than it was at the onset of the COVID virus. The difference now is that then the world quickly got to grips with the risks that COVID presented, and once it was fully understood, we were able to plot a recovery in a remarkably short space of time. However, it's not quite the case these days, and none of Trump's policy decisions or executive orders relating to trade have any quality of permanence. Business shrivels in chaotic uncertainty, and very few are prepared to make significant investments in such a climate. So in the absence of any sort of coherent master plan, we're left trying to decipher the end game strategy for ourselves, wondering whether there are any conditions at all, whether it's a looming economic recession or negative public opinion, under which this US administration might hesitate and reverse course. So that question remains unanswered, I'd say, as of today, meaning that any predictions that we make for the container shipping market, or any market for that matter, have an extremely short shelf life. I'd say we're in coin flip territory as we await really what happens during the 90-day pause on the reciprocal tariffs that will end in early July. Now, on Tuesday, the IMF downgraded its US GDP outlook for this year down to 1.8%. That's down nearly full 1 percentage point from the 2.7 that was given back in January. And the world outlook for this year shrunk from 3.3 to 2.8%. Moreover, I think the lurch towards protectionism is expected to greatly reduce international trade share of GDP. So there's going to be a real squeeze on the GDP to container multiplier in very quick order. We also saw the WTO. They predicted that world merchandise trade is going to contract by about 0.2% this year under current conditions. And because Drewry relies on these types of sort of third-party economic inputs for our own modeling of global and regional container handling, we too today are announcing a much more pessimistic container demand outlook than we presented to our subscribers last month. So the slide here you see summarizes our updated global port throughput forecast for 2025. And for clarity, this includes loaded boxes, empties, and transshipment moves, both inbound and outbound. So we're now expecting global container handling to decrease by 1% in 2025. Now that's the same level of roughly the same level of contraction that the market saw in 2020 with COVID, and it would be only the third year with any annual decline since Drewry's record started back in 1979. So for the North America region, which includes Canada, Mexico, as well as the US, we're now predicting a decline of 5.5% this year, and that will be followed up, in our view, by another substantial loss of 4.6% in 2026. That's not to say that Greater China won't suffer as well. Our revised outlook for this year is minus 4.8% for the region, although we do expect it to get back on the growth track much sooner than North America, as it will be able to find new markets, and we do expect growth to return next year in the region of 1.6%. Now, we have a lot of sympathy, I'd say, for container shipping executives trying to game plan for Trump 2.0. There are going to be very few, if any, upsides for container shipping from this trade war. Certainly, other countries will do more trade with one another, but any gains from this or new market disruptions, such as port congestion or temporary capacity shortages on really fast-growing trade routes, we think will be small when compared to the wider sort of contraction in overall demand for their services, in our view. So this comes at a time when the industry is already heavily oversupplied, so the trade war really has massively increased the risk for carriers. I think damage limitation really is the name of the game. To offset declining US trade, carriers are going to have to invest more in emerging trade routes and reduce their operational costs wherever they can. The immediate response, as we've already seen, is going to be more blank sailing for US-facing trades. But of course, this is really only a stopgap solution, and I think longer term, carriers will need to consider a more holistic downsizing of their fleets overall. So our supply side projections do include a fairly quick ramping up of idling and scrapping. We also foresee that ship owners are going to potentially push back to try to delay new build deliveries. And I think even in possibly in the worst case scenario, we could see some cancellations of recent orders. Now, on top of all of this, we have what looks like confirmation of the proposed plan to tax China-built ships, calling it US ports. Following public hearings in March, the US Trade Representative has last week presented a watered-down version of the original proposal that, at least initially, has a lower cost impact for non-Chinese operators. That last bit is, I have to stress that. China-based carriers, though, are effectively going to be priced out of US trades unless they are prepared to swallow the much higher taxes. So here's a quick sort of overview of the revised USTR scheme. The key differences between the new and the old proposals are fees will no longer be charged by the number of US ports of call, but they'll be done by string. That will reduce the risk that the smaller ports will be omitted and that larger ports could become congested. Ships with capacities of less than 4,000 TEU, which is rare on the Trans-Pacific, will now be exempt. Also exempt are sort of short sea routes shorter than 2,000 nautical miles. And also the original concept to charge operators based on percentages of China-built ships in their active fleet and also an order, they've also been done away with. So that last point really is very significant because actually at the moment only a very small proportion of ships on the biggest US trades were built in China. So I think that really means there's little basis for carriers to really push through and introduce any sort of related surcharges for this. But of course, due to the growing dominance of China in the shipbuilding market, these percentages that you see here would have increased in time without any government interference. So we have carried out a revised cost impact assessment using our databases and our insight into carrier costs. So I display them here using the example of the Asia to West Coast North America trade. Now, if carriers were to pass on the full cost of these fees from October when they start, shippers will be charged approximately $180 per 40-foot container for China-built ships, for of the non-Chinese carriers. And that translates to roughly 7% of the current sort of head haul Shanghai to Los Angeles spot rate, as per Drewry's World Container Index. But as you can see, these fees escalate through the years, and by 2028, the additional cost for non-Chinese carriers would rise to about $338 per 40 foot, or 13% of the prevailing WCI rate. Now, for shippers using COSCO, OOCL, or other smaller Chinese carriers, the situation will be different. If Chinese carriers were to pass on the full cost, shippers would be charged, as of October, $511 per 40 foot, and that's equivalent to 19% of the going WCI price. And by April 2028, that cost will surge to around $1,400 per 40 foot, or 53% of the WCI as it stands today. So this really shows just how disadvantaged Chinese operators will be, and that we should remember, though, still that ramp up in fees is going to be impactful for all other carriers, especially if they don't take any evasive action and continue to use Chinese-built ships in US trades. However, I think that's very unlikely to happen. We expect that these new fees will trigger a major shift of US-built ships over to non-US trades, and they will be replaced by similar fee-exempt vessels that were built in South Korea, Japan, and that's going to reduce the proportion of Chinese-built ships operated by non-Chinese carriers to less than the current percentages. So, of course, that will lower the amount of fees payable by carriers. Carriers with fewer Chinese ships will clearly have a marketing advantage. Shippers are going to seek to avoid any related surcharges, and there will also be ripple effects on both the new build and charter markets, whereby China ships will become much less desirable. So any significant increase that we might see in the premium for South Korean ships is likely to suppress overall demand for new builds. Of course, we have to remember they're currently mainly produced in China at the moment, and that perhaps is a blessing in disguise for carriers, considering the overcapacity situation that we have right now. Another market distortion arising from this USTR proposal, I think, relates to demolitions. The usefulness and value of non-China built ships will increase, and therefore owners will become less inclined to scrap those Korean, Japanese units, and that will potentially delay the rebalancing of the market. So back in the start of March this year, the aggregate capacity of all container ships of at least 20 years old was approximately 3.5 million TEU. So that's a sizable chunk of the market that could be theoretically culled, but only 6% of them were actually built in China. So if you don't, if you avoid non-Chinese ships from being scrapped, clearly you're limiting your potential. Now, there are also very serious operational questions that this proposal raises, especially for the Ocean Alliance carriers, which does include COSCO and OOCL. How are they going to share those fees that will, of course, be mainly incurred by the Chinese lines? Now, one solution would be to divide the ships up within the alliance across different trades, so that the Chinese carriers focus on non-US routes, such as the fee-exempt Asia-Euro market, while other Ocean Alliance carriers look after the Trans-Pacific and the Trans-Pacific markets. Trans-Pacific and Transatlantic. So This forced concentration of fewer carriers into the US lanes will reduce options for shippers, and depending on how things develop, it could even run into antitrust competition issues down the line if we find that just one or two carriers become very dominant. I think fundamentally, all of this tariffs plus the USTR proposal is going to make container shipping to and from the US much more expensive, certainly from October. Now, for an administration that purports to test big government, they seem very keen to be getting involved in things. Anyway, that's all from me, and now I'm going to hand over to Philip.
Thanks, Simon, and hello, everyone. So Simon has shown very effectively how the broad outlook for the container shipping market has changed in response to these new trade policies and economic challenges. But are there specific countries or specific industries which will experience reductions in imports and exports? And will there be winners from all this? So on this slide, we compare the current US import tariffs between China and other countries. That's on the left. And of course, we still do not know whether these tariffs will be implemented in full or permanently. So that's a caveat. But what we do know is that China will be hit the hardest among countries exporting to the US. Now, because China dominates US imports of consumer, retail, furniture, and industrial goods imported by container ship, these sectors will, as a sort of consequence, also suffer from the highest average import tariffs. So this is shown here in this chart on the right. The issue is that US consumers are sensitive to higher prices, and this will lead to a imports of these product categories, as they cannot be replaced by same price alternatives. According to a 2024 study, Haberkorn et al. On US tariff increases against China in 2018-19, they found that a 1% increase in US tariffs resulted in a 1% decline in trade 1 year after tariff imposition. So this is a risk we have to consider here. I will outline later the resulting fall in container volumes because of tariffs. In the Drewry container forecaster, Simon showed that we expect North American container traffic to fall, and this is a decline of 4 million TEU in 2025. Moving to the next slide. Our assessment of the impact of US tariffs is that neither the Asian producers nor the US importers will be able to absorb higher tariffs, and they will either charge consumers or charge industrial buyers more, or stop importing and exporting some products to the US. In turn, consumers will have to cut back on the number of imported products which they buy, particularly what we call discretionary consumer goods, hit by high tariffs such as cars, consumer and retail goods and furniture. So that's what this chart is about. We show here the exposure of various countries to whether they currently export mainly discretionary products or non-discretionary products. And you can see that Cambodia and Vietnam on the left, which specialized in producing such discretionary consumer goods, are more exposed to the new US tariffs, and they can expect to see declining volumes to the US unless they attract a lot more production from China at the same time. By contrast, on the right, you can see Singapore, which specializes in producing industrial and non-discretionary products, and the Philippines is strong in exporting food products, which are also non-discretionary, and these countries are less exposed to reduced US consumption caused by tariffs. But we have all heard reports of companies looking to shift some of their production and sourcing from China to Southeast Asia or other countries to get around some of the highest tariffs. So let us look at this. So this chart starts with the fact that US imports from China could fall by a huge amount. We estimate about 40% if 2/3 of the current tariffs remain in place. So that's the big blue block on the left. The question is this going to be a destruction of demand or a shift of sourcing away from China? In this chart, we show the current traffic of US imports from China and 14 mainly Asia-based countries and its potential evolution. Imports to the US from these 15 large countries total 22 million TEU in 2024. That's a big dark blue block on the left. But US imports from China will fall by some 4.5 million TEU, which is huge. And imports to the US from other countries will fall by about 0.3 million TEU. But surveys of shippers indicate that major companies are considering shifting to suppliers or shifting factories located outside China. Some customers of the Drewry benchmarking club have confirmed this to us in discussions. So our main current scenario of demand outlook for traffic to the US is that container volume from some countries other than China will rise in double digits due to the tariff issue and relocations over the next 2 years. In fact, at Drewry, we are assisting some companies on the feasibility of logistics from new locations. But the main message is that there will be a reduction in US imports, likely of more than 2 million TEUs. Now, moving to some more practical stuff or everyday stuff. So exporters and importers, as well as port carriers and forwarders, are facing considerable uncertainty in global market conditions and in the shipping sector, as we know. The tariff changes and uncertainty create swings in demand volumes, disruptions from cancelled sailings, disruptions from port congestion, and issues with empty container stocks like COVID. So the question is, what should people do about this? We also know that port activity in China and the US will be very weak in May. So Drewry has warned shippers and others to plan for difficult operational and shipping conditions in late June, July, if all the shippers engage in more front loading. And we are assisting shippers in adapting their logistics policies. And here we can identify 3 plans which we wanted to share with all of you. So the first plan we are finding is that numerous shippers are pausing shipments and trying to assess the impact of tariffs. This means clearly a big reduction in volumes in April and possibly May. Next, the next plan is that shippers will need to decide whether to replenish their inventory and pay the tariffs before the end of Trump's 90-day tariff pause on countries other than China, particularly if inventories have decreased. So that would be a big decision requiring some planning. This could also mean another surge of shipments to the US, another front loading before the end of July or before mid-July, and before the imposition of US fines on Chinese ships in October. Again, these big changes in demand have implications for ship capacity, availability, and freight rates. The third, more medium-term step is that shippers are considering shifting productions to countries with lower tariffs. In recent surveys, shippers said that they do expect to source more from India, Brazil, Vietnam, Malaysia, and Poland 3 years from now. And Turkey is another country that is mentioned by several of our shipper customers and that could benefit from relocation. So based on this third plan, we expect that India, Brazil, Vietnam, Malaysia, Poland, and Turkey are very likely to see rising container traffic volumes. So these are the relatively small winners of this difficult new environment. And in the Drewry container forecaster, we have already significantly upgraded volume forecast for Southeast Asia. Now we're going to move to Q&As, but I just wanted to mention that, of course, many of you will already be using our container forecaster or ocean freight rate benchmarking services. And from conversations we have been having with our customers over recent weeks, we are only too aware of how current market conditions are stoking uncertainty, with many companies reassessing their shipping strategies and sourcing options. So if you find yourself in a similar place, we just wanted to let you know we are here to help. For example, we'll be at Transport Logistics Munich, and we invite you to come and talk to us at the stand in Hall B2. And also, if you want information on the benchmarking club of shippers, do contacting us for other reasons at supplychains@drewry.co.uk.
Fantastic.
So, Q&As, Simon.
Yeah, thanks very much, Philip. Yep. So yeah, let's move on to the Q&A. Quite a few have come in. A number of people are asking whether or not they will get access to the PDF or the slides, and whether there's a video recording. Yes, so as I say, that will be dealt with in a follow-up email briefing that if you're registered, you will receive. Now let's see. Let's get some more and more substantive questions. Let's see what we've got. There's quite a few, so it's difficult to. Some of them are quite long. Right, let's try to summarize. What's the latest rate forecast for 2026 for intra-Asia, Far East to US East Coast and US West Coast? Okay, I'll take this one. I think, yeah. So the forecaster, Drewry does do sort of specific trade lane freight rate forecast that's sort of outside of the scope of this webinar right now. But I can tell you, so and in the forecaster, we predict rates for the current year +1 across sort of aggregate east-west trade and a global market average. Now, back in March, we had the forecast for this year for average rates, that's spot market and contract market combined. They were down approximately, I think it's about 15% this year. And I think by the time we come to revise those for the June edition, I don't think that certainly the direction of travel will be the same, but it's possible that very likely that there will be even further decreases. So yeah, if anyone is interested in sort of specific trade lane freight rate forecast, please get in touch with us, and we can certainly work on those. Let's see what else we've got.
Question here, Simon. Is an increase in exports from Europe and UK to the US expected on the back of China tariffs?
So yeah, you go ahead.
Europe and UK to US. So I can say no. We do expect a reduction in European and UK exports to the US, unfortunately.
Okay. Okay, what else have we got? So someone's asking, are you expecting carriers to reshuffle their fleet enough to avoid the 15 to 23% in Chinese ships in service to the US? I think the answer is yes. I think that is assuming that this policy remains unchanged. That's not a given. As we know, with this administration, things change very quickly, but assuming it does come in as planned from October, and because, as I say, it's a relatively small proportion of ships serving the US are made in China, that should be quite achievable. And to the fact, of course, if the US market is smaller than it was previously, that will also make things a little bit easier from an operational perspective, at least, if not anything else. So yes, I think that there will be a big reshuffle. And I think that will carry some risk of its own, as you know, as the chessboard gets moved about. Whenever we see these sorts of structural deployment network changes, there's always a sort of a little bit of a breaking down of operational performance. So it's possible that we could see some issues related to that. And as I say, I think overall, though, the net impact is obviously not great from a carrier perspective, but there will be some disruption related to that.
That's an interesting question. Will the reallocation of the fleet in terms of carriers' equipment affect freight rates on the other trade lanes? So,
yeah.
So I think we're likely to see effectively Chinese ship from COSCO and OCL looking for new homes. It's possible we're going to see that China-built ships will find it more profitable to trade in non-US trades. So yes, I think it will have an impact on freight rates for non-US trade. It's going to be such a big change, affecting such a big portion of a global trade, that it will have impact on many, many different trades.
Yeah, huge number of ripple effects here. Another question someone is asking, how do you expect the tariffs, port fees to affect the global scrapping volumes in the coming years? Yeah, so I mean, to be honest with you, we had already, before tariffs were confirmed and the port fees came up, due to the nature of the structure, the fundamentals of the market being so heavily oversupplied, we believe that there was an absolute necessity for scrapping to increase. Now that really got kind of delayed due to the Red Sea crisis. Suez transit is being shut down, and we're still waiting. Basically, the level of scrapping is minuscule at the moment. I think this year so far there may be less than 5,000 TEU that's been demolished, so it's still on pause. But clearly, if you have a contracting market, freight rates falling, all the rest of it, that imperative to scrap will just get even bigger. So we think that this will accelerate or expedite that timeline for when scrapping will come in. We're still, like I say, still waiting for it, but our models, our forecasts certainly build in that, and as I say, we also anticipate quite a high uptick in idling as well.
There's a question here referring to slide 8. Do you have such a study of additional costs from US fees on China ships for the transatlantic trade? So we have quantified this for all East-West major trades, but for this it's available for customers of the benchmarking club and container forecaster. So if you're interested in this, contact us. It's part of the package. We also have a lot more details on volume by regions, which we didn't cover here. So I'm afraid we can't answer a lot of country-specific questions, but we have a fair amount of additional information in the container forecaster.
Yeah. Okay, I think maybe we've got time for one more question. Maybe this is one for you, Philip. On the freight rates, is saying someone's asking whether we would recommend to fix current low rates from China to Europe, or do you expect further reductions in rates?
We do expect further reductions in rates. Yes. So we effectively we haven't discussed this, but there's also the possibility that the Suez Canal will reopen at some point. So I think it's important, if you negotiate a year-long agreement, to have what we call a review clause, so that if the market changes by a given percentage, then as a buyer, you are entitled to request a renegotiation of rates, and there are different mechanisms for this. But fixing now, as the market is about to fall, is definitely not the right approach.
That's great. Thanks, Philip. Okay, so I think, unfortunately, yeah, we've come to the end of our allotted time. So as mentioned, we will try to answer as many of those unanswered questions that we've received, so long as they are in scope, as it were, and we will list those out in a follow-up email that you should get in a day or so. So really, all that remains to say is that we hope you found today's webinar useful, and we look forward to seeing you at future Drewry events. So goodbye and have a really good day.
Goodbye.